So you've got the worst end of the credit market, and I put it in a category, it's subprime, it's the subprime of 2008. It is the junk bonds of 1980. It is the savings and loans garbage crisis of those 80s as well. So it is essentially the worst end of the debt and credit markets that is fraying and collapsing. And it is typically where you always start. You start on the most endangered debt, the most high-risk debt, and private credit is that. So fiat is in a downward debasement. Gold wins in the end. It's going to do the exact opposite of the Ernest Hemingway curve, that is slowly at first and then suddenly at very fast going bankrupt. So we're about to acknowledge a mass amount of fiat and debt devaluation.
The collapse of the global credit market is currently mirroring the most catastrophic debt failures in history, starting with the most vulnerable layers of high-risk private credit. This sector represents the subprime equivalent of 2008, signaling the terminal phase of fiat currency debasement before a sudden, vertical devaluation. FrancisHunt, a prominent market strategist known as the market sniper, argues that we are currently at the suddenly phase of the Hemingway curve, where bankruptcy happens slowly at first and then all at once. Data from early 2026 indicates that the private credit market, which has swelled to over $1.7 trillion globally, is beginning to fracture as interest rates remain elevated above 5%. With default rates in lower-tier junk debt rising towards 6.2%, the same levels seen during the 1980s savings and loan crisis, the fraying of these high-risk bonds is a precursor to a massive fiat revaluation. As the global debt-to-GDP ratio hovers near 330%, Hunt emphasizes that gold is the ultimate beneficiary of this credit destruction, prepared to surge as the world finally acknowledges the insolvency of the paper-based system. Now, we present the clips from FrancisHunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This is an engineered narrative that leads to further debt and fiat-based collapse, which means rates go up on debt collapse, and that initially is deemed negative for precious metals because they are non-yielding, they are preservational. But in actual fact, macro, it's highly bullish precious metals. So it's a kind of, you take 2 steps to jump 10 forward. It's a bit of like doing the long jump. You know, you've got to go backwards to the whole run up to make that, that 3-meter leap. And as a result of that, we are going to have to go through that phase. A lot of people that are in the precious metal markets are in far worse assets, such as potentially private credit, which is a fancy way of saying the new junk bond debt market, only worse because the issuers get to set the price. There's no exchange where supply and demand dynamics do that. And because of that, they're the market maker. It's not in their interest to market to the downside because that causes panic. And it means they are also marketing their own assets downside. And of course, many of them are banks. And they are also the liquidity provider if you want to exit, and they don't have the liquidity they need to deal with a stampede. So you've got the worst end of the credit market, and I put it in a category, it's subprime, it's the subprime of 2008. It is the junk bonds of 1980. It is the savings and loans garbage crisis of those 80s as well. So it is essentially the worst end of the debt and credit markets that is fraying and collapsing. And it is typically where you always start. You start on the most endangered debt, the most high-risk debt, and private credit is that. So what's happening is certain people might need liquidity and they will sell other things that have served them well. So the typical malaise of a trader is that they don't like to lock in losses, because that means it's an acknowledgement, it's a mark to market, it's pain. So they actually cross-subsidize winning positions by selling good to cover and hodl bad. And it's a beginner rookies retail trader era when you are a trader, but it is also a forced line of action for highly committed funds that have high-risk debt in the same space as they might have performing assets like gold. And sadly, to not acknowledge a loss and hope that it comes back means the original price still holds. So I don't know if you remember the scene in The Big Short with Michael Burry, but he'd given up chasing Goldman Sachs to admit that what he'd shorted had lost just about all its value. They kept insisting it was par, because they hadn't laid off the risk themselves yet. And only once they'd laid off the risk on AIG were they prepared to acknowledge the full devaluation of the subprime portfolio that he'd shorted. And he'd shorted the worst 3%. And there'd already been, 10, 15% in redundancies on debt. So he knew already that he was deep in the money and they weren't acknowledging. But they wouldn't let him short anymore. And they were trying to squeeze him out of margin because they were the counterparty until they laid that risk off.
Right.
So that's a perverse set of dynamics, and that's what you have in private credit that you were mentioning, which is why I say an HYG, a high yield ETF, at least you can panic sell. Yes, it will spill, but you can, and it's trades on an exchange, and there's buyers and sellers. It might not be very liquid. It might fall a lot on minor volume, but at least you can say, listen, I just absolutely want out at any price, and you can whale sell out of there. Private credit, you can't even do that. You're reliant on the person who created the asset to give you a fair price and to provide the liquidity for your exit. And what are they doing? They're restricting the degree you can leave. So they don't have the liquidity. So we are at the worst end of the debt failing, and other more serious debt instruments will fail. And I've already begun to see that previously prime lending people are starting to fail on cars and properties to a much higher degree. So we've already gone from the worst layer of debt to what's typically considered everyday lending, bread and butter stuff that's easily waved through. Just the interest rate has to be determined. In other words, not someone who's considered a high risk category. So that's where we are in the debt cycle. When we last spoke to you, we said all of this would happen. Rates will go higher for longer. Pullbacks will be shorter. Weren't we supposed to be getting rate cuts? That whole drama with Trump and Powell, all about rates should be lower. Do you think you're going to get cuts now? Don't forget, you're in essentially a recession. You had a negative non-farm payrolls number. You had an increase in unemployment, and you've got exceptionally low wage growth. It's at about 0.4. It's about 4.8 on wages in an environment. True inflation is far, far higher. So they need to restate honestly what inflation is. So they lied about labor numbers and on the payrolls number. That's been exposed after multiple revisions, annually, monthly, quarterly, you name it. The other lie is the CPI. So it's propaganda. They tell you right now that inflation is 2.4, 2.5. So you're going to roll into, and now that we're going to get these price increases that are going to come, the understate is suddenly going to get corrected, and it's all going to be blamed on Iran's nuclear threat did this. Not, hey, we've proliferated way more fiat and debt instruments than anyone has ever got away with doing in an entire global system ever before. And proliferation of fiat is debasement. No. They don't do those kind of admittals. Iran did this, the nuclear threat. We had to react. And guess what? So there were knock-on effects, the contagion, Who could have seen this happen? All the acting stupid will continue. But the key thing is that the debt gets debased in the end by interest rates rising. And you've already seen that on the Aussie 10-year, the US 10-year. They all popped up once they traded technically below the 4%, the Aussie. The US 10-year, and the Australian that was at about 4.2s now got a target of 5.75 heading for 6 and is moving strongly up as well. So Australia, that never had a house market correction, really. They went a little bit soft, but never had a crash during subprime because of China buying copper and ores from locally. That's going to hit them particularly hard. So this is all coming. This is the great asset bubble deflation. And we've said fiat is no longer a unit of account of any consistency or of true value. It's a monkey on a grease pole that is sliding down. People have seen the stock market nominally go up on the tech side. And in actual fact, we've considered to say to all these melt-up heroes, listen, it's debasing down because your new unit of account is a gold ounce. However, in that deflationary hit, when everybody realizes there's a problem, a lot of dollars die because debt dies, it gets devalued, a lot of things get marked down, a lot of money gets destroyed. So in the short term, you actually have a reduction of liquidity, a reduction of money because they're exploding, values re-rating downwards. So you actually get a bit of dollar death. And that causes the value because of a short-term scarcity to actually escalate in the dollar, and that causes a bit of an off in gold. And because you're also getting a higher interest rate, short-termist, everyone dashes to cash. So that's the description of the scenario of where we're in. Very similar to the 70s. And just to finish the parallel, and then I'll hand back because I've been going for a while. In the 70s, we had the exact same thing. The excess expenditure of World War II by America then rolled into Vietnam. They dropped more munitions, just one nation, than all they dropped in World War II in Vietnam. Then they got called on it. Nixon got called by the French. They were printing more dollars than they had gold. They were cheating and lying. Yes, that's what they do. And they got called on it. France took the gold, handed them back their paper. They then closed the window and they went free float. So previously they had a bit of a rev limiter. You know, you had this 1300cc motorcycle that can do 300 kilometers an hour. But to save you from killing yourself, maximum speed was 180 and the revs wouldn't go above 5,000. Now you've got the situation is they removed the rev limiter and we've absolutely spun the wheel. So this first cycle is 1913 to 71. Where you had some degree of restriction, only how much you could cheat before you got caught. That started, they got caught, they removed the discipline, and now you've got a cycle from 71 to 26, where we are today, where you've had an absolute proliferation at every opportunity. So fiat is in a downward debasement. Gold wins in the end. It's going to do the exact opposite of the Ernest Hemingway curve, that is slowly at first and then suddenly at very fast going bankrupt. So we're about to acknowledge a mass amount of fiat and debt devaluation. It should have been linear, but because of the set of circumstances, it requires contagion to rebase. So you get away with it for a long time, and then all of your bad news and all the dead bodies you buried all getting covered at once. And that's where we are now. And gold does the exact corollary. So you will get a pullback, and then we run.
The current financial crisis is an engineered narrative designed to mask a terminal fiat-based collapse. As the private credit sector, the 2026 equivalent of the 2008 subprime bubble, begins to fray, the lack of transparency and liquidity in these non-exchange traded assets creates a dangerous trap for investors. Because these assets are not marked to market by supply and demand, but by the issuers themselves, a sudden stampede for the exit will find no liquidity. This structural failure forces funds to sell their winning positions, like gold, to cover losses in failing debt, creating a short-term liquidity crunch that temporarily strengthens the dollar while artificially depressing precious metals. We are witnessing a repeat of the 1970s cycle, where massive government overspending and monetary debasement eventually lead to a sudden revaluation. While official propaganda understates inflation at 2.4%, the reality of surging energy and food prices is poised to expose the proliferation of fiat instruments. As the U.S. 10-year Treasury target moves towards 6%, the rev limiter on debt has been removed, setting the stage for gold to transition from its current pullback into a vertical run as the ultimate unit of account. This is the great asset bubble deflation where debt dies, and only hard assets survive the reset. Let's get back to the interview.
We've been long gold aggressively and we're investors in gold, but we've also been leveraged traders in gold. We were fortunate to exit before the collapse, the slap in the face collapse that occurred on both gold and silver. And we've been waiting for a moment to get back in, and we've been entertaining ourselves with this particular market, and I'll show it to you. And this will, because you asked about a geopolitical event, I think this is the technical repercussions of a potential political event. Let me just show you this trade. It is, first of all, it's the dollar, and you might get a spike in dollar strength. So we are preparing for a spike in dollar strength. This is the South Korean won. It's a small but first world Asian nation with the worst demographics, worse than Japan, 0.88 per couple versus 0.91 in Japan in terms of replacement per couple. So they don't even replace one single person. This is an hourly setup, and I'm going to take you through 3+1 time frames. We've just had a volatility constriction here, which is squeezing, and we expect the Korean won to devalue. It broke here. We got in long there. It had a nice little return move falling wedge with 3 impulse, which is typical of what we expect. And it went really low vol, and now it's breaking to the upside. That's the H1. That's a trigger of this dotted red line. I'm going to talk to you about this dotted red line, why this is a fractal at a key level of significance, just for your interest. So if I take you up to the daily, for example, now, and you'll see more with this dotted red line, you'll see that we had, and all of these things have one thing in common, volatility constrictions. Here you had a falling wedge like this that is bumping up again against the red line, and I will come and talk more with you about that red line, where it comes. And we had this squeeze here. And again, you could have been going long on the break of that on the daily time frame. Let's get to the macro, well, because that's where things really get interesting. So we are at this red line and just through it right now. And I'll show you what's happening on the weekly. We're going up the time frames. Let's clean that up. So we are expecting a Korean won currency crisis against the dollar. This is an Asian nation. 60 to 70% of light natural gas and oil is going to Asia through the Straits of Hormuz. The Straits of Hormuz is very much an Asian problem. You have this large rising wedge. Now I'm going to take you to the monthly time frame so you can see that large rising wedge in context. And I'm going to move this setup here and show you that we have one of the biggest setups we've ever had in FX. I'm going to even have to move to the 2 months to get a little bit more perspective for you. This is a macro, a very big Asian crisis, currency crisis call, particularly for the won. So our primary reference is on the Korean won. Sorry. So let's have a look at that. You'll see it here. Bang, bang, and bang. And by the way, the 90s Asian crisis came in a similar way. What do you notice about everything? Pinches to low volatility suddenly detonate to extreme high volatility. Extreme low volatility, there's a very tiny little moving candles over there. Trigger, major overshoot. Target was smashed. The target was there, massive overshoot. Asian FX crisis, 97, 98. Then now you have the same 3 impulses all the way through into this impulse, and you have broken and triggered, and you were in this rising wedge that I've drawn for you on the weekly time frame inside our what we call our funnel, our HVF method funnel. So this is a triggering, and this is a currency run through 2,740. And that when we were getting involved in this, it was 1,400. So almost a doubling. Which is a halving of the buying power of the Korean won to the dollar. It's also in similar setups against the Chinese yuan, by the way. So South Korea is particularly vulnerable. Why is that? They have a massive Kospi AI bubble. What's bad for AI? High interest rates. What is Straits of Hormuz? What is everything I've said? So the interest rates will escalate. That will bring about a tech bubble-based collapse and contagion. And what did that do? Well, the NASDAQ went up 50%, gold went up 70%. So actually the NASDAQ was re-rating downwards to gold because I treat a gold ounce as my basis of account. But let's just have a look what's been happening on the Korean won. The Kospi has gone up, wait for it, since April, the March low of last year. This is a log scale chart. If you, let me grab that from the bottom to where you are today, you are up 159% and to the all-time high 177% in less than a year. And what's the reason? Samsung, SK Hynix, you name it, AI-related bubble. And just so that you can see how extreme that is, I'm going to take this long-term chart off log scale for a while. That's how much that stock market has moved in normal nominal scale.
The convergence of demographic collapse and a hyper-extended AI bubble has placed the South Korean won at the epicenter of a looming Asian currency crisis. With replacement rates falling below 0.88, South Korea's structural weakness is being exposed by a massive volatility constriction, a technical setup reminiscent of the 1997 to 1998 Asian FX crisis. As the Straits of Hormuz remains a critical choke point for Asian energy, the resulting surge in interest rates is poised to detonate the Kospi tech bubble, which has ballooned 177% in less than a year. This macro-technical trigger suggests a halving of the won's purchasing power against the dollar, forcing a violent re-rating of equity markets downward against the true unit of account, the gold ounce. The breaking of the $1,400 level marks a fractal shift toward a $2,740 target, signaling that the AI melt-up is entering its terminal deflationary phase. As the Nasdaq and Kospi continue to re-rate lower in gold terms, the necessity for a hard asset hedge becomes undeniable for anyone caught in the crosshairs of this regional contagion. We are witnessing the end of the debt-fueled tech mania and the return of a disciplined, gold-based monetary reality. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.